Hello and welcome to this webinar. My name is Chris Baxter. I'm a business consultant here at aixigo. I'm really excited to show you the cash flow planner. Today we'll be looking at a specific use case, namely retirement planning. So whilst most financial planning packages focus on enabling you to increasing sales profitability or saving the advisor time, we've looked at this a little bit differently. We found that there are few tools on the market that can really help an advisor answer the key and tough questions a client will have. Things such as, will my assets provide financial security even in difficult times? Or do I have enough money in retirement? The tool is currently available as a freemium version online. You can see the link here below. And we'll be really happy if you try it out and see for yourself. So what we'll be looking at today is a case study of John and Sally. So they're in their mid-60s and they're looking to go into retirement. They want to know if they have enough money to retire a little bit earlier. In this case study, we'll see how we can help them to achieve that goal. Also, they have a few other objectives, namely John would like to lease a new car. We'll put this into the simulation and see if he can afford that. When this is done, we'll stress test the situation and see how that works, whether they can survive a market crash or what would happen if, God forbid, John were to die earlier. So at this point, I will now switch to the tool. So the version I'm using today is the freemium version, which you can try yourself for free. So I will quickly log on using my email address. Add in my password. And then sign on. So when we sign on, I'll land on my case selection page. I will see all of my cases. Here it's possible to search and filter through all the cases and add a new case. Each case can be opened, can be copied or deleted. So say a client comes back a year later, you can take their old case and populate it in a new one. So I've already prepared this case to save us having to type in all the information, and here we can see it. So here you can see we have John and Sally Smith. They're in their early 60s and are married. They are both employed and live in the UK. They have a joint income of £105,000 with a surplus of £2,500 a month. They have an emergency fund of £30,000 and own a property together worth £400,000. We jump down quickly to loans and liabilities. We can see they have a mortgage on this, which is almost paid off, just the last £30,000, and they're paying off £1,200 a month. In cash, they have a total of £53,000 split between their current accounts and their emergency fund in a building society, and have in both of their ISAs £220,000, giving them a grand total of £673,000. We've just looked at the loan already, so we can skip past that and go and look at their pensions. So Sally has a pension. She has a defined benefit pension worth £18,000 a year. And John has a SIP worth £190,000, and he's currently still contributing £500 a month. So as we mentioned, they want to see if they can go into retirement in 2 years' time, a bit earlier than the normal age. And they would want a combined amount in retirement of £34,000 a year. They currently don't have any protection plans. So here we've added all the fact find information. I can now switch to the cash flow tab. And before we go and have a look at the graphs, I will just jump to the data tab. So here we can add further parameters to help the simulation. So namely, we can add what's the growth rate per income, what should be passed on to a survivor, when the income is valid from and to, per client. You can say this has already been filled in. So they currently have their employment that will run for the next 2 years when they go into retirement, and they will have their full state pension from 2030. Sally the same, just she will get hers a year earlier. Then again, we can see that surplus of £2,500 a month. They have their emergency fund, and we've agreed that that is a fair amount. 30,000 is the required amount, so that will not change. This field is important as all money here will never be used. That is saved away, and only when it's necessary will it be touched. So we can see they wanted £34,000 in retirement. Here we can add further information. So currently they spend around £45,000 a year. They need a little bit less in retirement, and if one of them were to pass away, that would be reduced further to £25,000. Now we can add further parameters to the assets and investments. So here we can see their property, the growth rate, and what will be passed on to the survivor. The cash accounts, again, this can all be manually configured. We can also add whether they have any regular savings. Their investments, the growth rate, whether there's a yield, and whether they have any savings or they would like to withdraw money on a yearly basis. So in this case, we can see that John is saving £250 a month into his ISA still, and he'll do that until he goes into retirement in 2024. The loans and liabilities, here we can see the mortgage, and we can see that it's still being repaid. And here we can add the growth rate for John's SIP, and also the growth rate for Sally's DB pension. Again, they don't have any protection plans, so there's no information here. Now we can see how we would like the simulation to run, whether it should be shown in real terms or in nominal terms, and further information about the lifetime allowance. As we're not looking at inheritance tax planning this time, we can leave that one for today. That will be a subject of another webinar video. Then we get to the liquidation and investment order. So this is incredibly important in the simulation. So how it works is there's a liquidity pot each year, and whether there's a surplus, that money will be invested. Here we can choose in what order that is invested and into which accounts. So in this case, all extra money will be invested firstly into a stocks and shares ISA, then a bank, a building society, and unit trusts. Now this can be freely moved around. Say current accounts is important, there the money should go, so we can move that up. We can also exclude specific assets which should be invested in. The same goes for the liquidation order. As you can see here, in the best case, we wouldn't like to sell their residence. They would like to have somewhere to live, so that's been excluded. And we can see the order in which things will be sold if they have a shortfall. So now we can jump to the graphs. Here we have 4 different graphs that we can look at. So firstly, the assets. So here we can clearly see that they're still in the accumulation phase for the next 3 years. In the end, they'll have about £938,000, and then they'll go into retirement. So here we can see that here, below in the events. Then they go into the decumulation phase. As we can see, they slowly start spending their money. And at the assumed date, so here we take the Office of National Statistics, the assumed death, and we can actually see that they will still have some money left over. So actually, they're okay, they can go into retirement. But if we go and have a look at their annual income, we can see that when they go into retirement, they have a large shortfall and they will have to sell assets. So for example, in the first year, we can clearly see that asset sales contribute for the entire year. So here we can maybe look at improving this plan to make sure that their income meets their required income. Then we can go and have a look at the loans and liabilities. Now, as we saw in the fact find, they only had their mortgage left over and only 30,000 left. So that will have been paid off in the next 3 years. So that's all okay. And finally, we have a moving IHT liability. In this case, they don't have any IHT liability, but again, that's something we'll go and have a look at in another webinar. So now we can go and add events. So in the system, there are 2 types of events. We have what-if events and also stress tests. So if we jump over back onto the data and events tab, move to the events, we can add specific events which then can be added into the simulation. So John mentioned he would like to lease a new car when he goes into retirement. So here we can see that's been added by adding the individual one-off event, so the £20,000 down payment that will be done in 2025. and then a yearly rate of £8,400 to lease the car for the next 3 years. So these two events have been added. We then have an account transfer, so it's possible to transfer money from one account to another. A pension transfer, this is something we'll look to do as John takes his pension, and then we can look at investing that into an annuity to make sure they reach their goal, their income goal. Then we have the stress test. So here we'll be looking at what happens if there's a market crash of 40% in 2030, how will the plan hold up? And also what would happen if John were to die earlier, if he was to die at 70 as opposed to the expected mortality age of 96. We could also do other stress tests, so we could look at an income drop, say one of them were to lose their jobs, or one of them would like to go part-time for a period. However, as it's only 2 years before their retirement, we won't look at this in this case. And then specific insurances, so incapacity, income protection, critical illness, life insurance, family income protection. And as you can see here, we've added a life insurance protection in case John were to die early, what they could do about that, how would that affect the plan, whether they need it or not. So now we can go and have a look at the graph again. Now we can move into a compare mode and we can see the two different graphs. Now here we can configure each of these separately with the specific events. So firstly, we want to see within this plan if John can afford that new car. So we can simply add the down payment and add the car leasing. And in this case, we can see that at the end, at the expected death of Sally, they still have some money left over. So we can see that actually they can probably afford this car. But maybe what's more important is we would like to see how they can bridge this gap where they have to sell assets to meet their income. So then we can go back to the event and look at that pension transfer. So John transferring his SIP, taking 25% cash free and then buying an annuity. In this case, we can see that they will still have money until the end. So 469,000 as opposed to 498, so a little bit less money. But if we move over to the income, we can actually see where they had a shortfall each year of around £7,000, so where they had to sell assets. Now that's dropped to only 961, so less than £1,000. So actually this is maybe a more robust plan as they have the expected, they receive enough income to meet their required amount. Now we can go and stress test this. So I switch back to assets. And here we can see the market crash. So what would happen if there was a market crash? In this case, we can see a significant drop in assets over the past years after the crash. So the crash happening here in 2030, and if we take a random year in the future, so 2041, you can see, if I move to assets here, that actually it has a significant difference, but actually at the end they will still have some money left over. So they probably would be able to survive a crash. And then finally, the second stress test. What would happen if John were to die early? So we will add this in. Here we can see that his expected death is now, or the assumed death is now in 2032. And we can see that the annual income is still more or less covers it. They need 1,000 to sell asset sales, or Sally needs to sell assets of £1,689 a year, or in this year, to reach that. So it should be okay, but we could look at what having a life insurance plan does. So if we add the life insurance protection, we can see that it makes a significant difference. And actually, if we look at this specific year, doesn't matter that much if he were to die earlier, in a not so nice way to say it. Now, after all this has been done, what we can do at any point and what's updated on the fly is this export tab, where we have all the assumptions added into a report which can easily be shared with a client or added into a suitability report. So here we have all the assumptions. So which are the main assumptions which were used? What were the asset allocations? Charges? And we have the graphs. Now these can then easily be added into any report. In the free version, we have this aixigo watermark. It's also possible to buy a premium version or to subscribe to a premium version. This is then naturally taken out. So here we have the full information and all the assumptions which were used, and in great detail. I don't think I need to go through it all, but as you can see, it's all covered. And again, this is always updates on the fly, so then can be easily added into any report. So I think in the first webinar, we've shown a fair amount of functionality that we have, and we would welcome any questions.